So broadly speaking, you get two types of investors. You get your growth and your value investors. Now, growth investors are basically like to invest in companies that are growing faster than average and are more highly rated, which is basically a fancy way of saying they're relatively more expensive as reflected by some kind of a multiple. Value, that's companies that are growing slower than average and are more lowly rated or relatively cheaper. For those that don't know, this gentleman on the picture here is Warren Buffett, the world's most famous investor. And he would argue that growth and value are two sides of the same coin. However, in reality, most people do distinguish between these two categories. And as David did mention, we probably would put ourselves of the two into the growth camp. I would also say that growth can be separated into two more categories: quality growth and hyper growth. Quality characteristics are those are businesses that are basically more mature or established. They still deliver above average growth. They possess a competitive advantage, and they generally produce high returns on capital. And when I say high returns on capital, I don't mean the stock price going higher. I mean companies taking their resources and invest them into the business, be it stock, new equipment, software, people, and the return they generate from that investment. On hypergrowth, the characteristics for those companies, they're generally earlier in their life cycle, maybe startups. They do have high growth, mostly on the top line or sales, but they tend not to have a competitive advantage in the earlier stages. And their profitability may be quite limited, or they might actually be loss-making. Of these two, we prefer to focus on the former, the quality growth. So there's three characteristics to quality growth: predictable cash generation, sustainably high returns on capital, and attractive growth opportunities into which those high returns can be reinvested. Individually, each of these characteristics would be desirable, but if you combine them, you create a powerful virtuous cycle of cash generation. So let's move on to the why. Why do we like to invest this way? First of all, we are long-term investors, and over the long term, stock prices tend to follow earnings, not the other way around. Therefore, the more earnings you can generate, the more valuable the company will become. That statement is quite obvious, but let's ask the question: how can a company grow its earnings? Well, one way is by deploying or reinvesting capital at high rates of return to drive the earnings growth. And to quote Mr. Buffett again, leaving the question of price aside, the best business to own is one that, over an extended period, can employ large amounts of incremental capital at very high rates of return. To put that simply, companies that have high reinvestment and high returns on capital are the best investments.